Like if that's how you got started, like no shame in that, right? Getting started is the most important thing.
Funny because I joked that this is like 100% of my portfolio because at the moment I've made money in both of these. But here's the thing. I think you're right. The people investing in beyond me at this moment are gamblers.
We've been on this journey and like come on this journey with us because we're all going to feel the pain together. And hopefully we're going to emerge unscathed the other side.
Yes, because rumor has it, Badger had some cash register dinging, chinging, ding, 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 ching, ching, ching.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Christoph the Monkey Piekarski. This week, how Peter Lynch can help you avoid panic selling. Monkey's got a PayPal dilemma for me. We're going to discuss it live the day before earnings. He's broken my reverse discounted cash flow model somehow. I am going to dive into Intuitive Surgical's latest stellar quarter, and I'm going to be screen sharing again if you're on the YouTubes and show you how I review quarterly earnings, plus a devastating estate tax that I just learned about that could wipe out 40% of your investment portfolio. Stay tuned for the back of the episode to understand what that's all about.
Oh no, 40% Badge?
Seriously?
That's a lot. That's a lot to wipe out.
Seriously, dude, seriously. I know it's estate tax and you're dead. But anyway, we'll come to that at the back.
Okay, we'll get to that. So let's start with the panic stuff because this is the timely conversation, right? This is when everyone thinks they're a genius and Monkey and his uncle and everybody wants to get on the investing train now, right? But we have a slightly more gloomy-ish message to deliver. What do we have to tell people this time around?
Yeah, I really want to reflect again on stuff we talked about last week in episode 103, because I think this is really, really important right now. And this was actually brought home to me by, like, I'm constantly on like WhatsApp chatting to friends and family about investing. And like a few close friends of mine, including my brother Matt, are spreading the good word about the power of investing. The podcast, they like the mission of the podcast, but they're telling their friends like how investing can change the trajectory of their lives. And like literally to quote from a conversation with my brother this morning, there is a wonderful thing happening here. You're changing the lives of people you don't even know. That's like you and me, Christoph.
We're doing it. We're doing it.
This is like, you're right to be excited. This is superb news. And this is why I'm like so passionate about investing and this topic in particular. And like we were chatting to Edgy from Dividend Talk just a couple of days ago. And like I said the same thing to him there, like the stuff you and I are doing with our King of the Jungle portfolio shows how small amounts of money, but like adding money regularly every month, every quarter, and then taking a long time, that can add up to a lot over time. But at the same time, like this is why I'm nervous, because if you are a newer investor, and I'm going to give you a case in point, I don't know this guy personally, but one of my buddy Matt's good friends, Rich, like nice to meet you through the medium of the podcast. Now I gather Rich is making bank right now because he's got like a lot of his investments. He's a newer investor. He's got a lot of investments in ASTS and IREN, they have just done incredibly this year, like two classic monkey stocks that I happen to own both of as well. But these are from your side of the scorecard, really. And I'm sure Rich ain't alone. There's like a bunch of folk. If you're a newer investor, well, IREN in particular, like I looked at all our social media shorts. That's like the most viewed video of all of our shorts. And like the IREN short had 60 comments alone. It's just like people constantly like, should I buy it? Should I sell it? Like panic, what's going on? Like if you've just found our podcast by word of mouth or maybe organically on social media, if you started investing in the last 2 years, then you would be absolutely forgiven for thinking stocks only go up, because that's been your experience of the market for the last couple of years. This is not normal. Like, what, between us, we have 50 years of investing experience. I'm like 22, 23 years, and you're more than that. Like, have you ever seen a market like this one?
I have actually twice.
Gone.
God, well, I was a junior in college, I think. So this must have been around 2000, 2001, where I looked at, my portfolio and things were going up by the 10s, 20, 30% clip, the internet boom period. So that was one. That's the first one. And then also kind of right post COVID, when the entire market decided that anything online and digital is going to be worth 40 times as much when the whole world is never going to go outside again ever. So that was two. Maybe then three, because I had also in mind as soon as no, that's plenty. Those two times are plenty where every day the portfolio was just jumping.
But for such a protracted, like multi-year period, I'm with you. I probably wasn't big in the market in the early 2000s. My first growth stock was like 2006. But I was there during COVID. Maybe that was like 18 months of like the good times. And you're right, like everything was going bananas. But probably I didn't have multiple multi-baggers over the course of months, which is what I'm seeing in my portfolio right now. Like my two fastest growers are those two stocks, ASTS and IREN. Like they're both 3-4 baggers for me in like as many months, pretty much. It's unusual. But okay, even if it's, I mean, it's certainly not normal. Even if it's not unprecedented, it's unusual, right? And the thing that worries me is if you're a new investor, you think this is just what it's like all the time, and this is not what it's like all the time. It's like the market goes in these cycles and these swings. And like the concerning thing is maybe in particular with like ASTS and IREN and a bunch of other young companies, we don't actually know if they're going to become like big behemoths. We might be really confident in their mission and where they are and the maturity and all of the thesis might be really strong, but they're still young, tiny companies. They can still fail. And they're more likely to fail than something like a Amazon or an Alphabet, which is like established, like very, very established. And the trouble is, you've got, let's say quantum computing, right? You've got dog shit stocks. I'm sorry if you like quantum computing. If you do, I disagree with you. That's fine. You've got great companies and you've got terrible companies, and they're all going up. And when you're in the middle of it, it's quite hard to tell the difference. And even I don't know the difference. Like ASTS and IREN, one of them might succeed and one might fail. And if you told me that was the outcome, I couldn't tell you which was which, right? I don't know today. I've got to see how it plays out. So I feel a bit safer owning those two because they are like two stocks among 30 stocks that I own. And I'm pretty well diversified. And my bigger allocations are in my more established positions. And I got smaller amounts in the more prospective stuff. I know you do things differently, and tell us about your strategy and why you're more comfortable having like larger allocations in these smaller companies. But even then, you're pretty diversified, right?
Okay, boy, there's a lot there. Let me actually take it one step back, maybe in order, I think, of importance. Forget IREN for a second and forget AST. I think there's a bigger point. And you name dropped this ticker appropriately, I think, Amazon. Here's I think what new people will not know because they don't have the experience. When you invested in Amazon early, and that could be actually any number of years, if you had a time machine to go into the future, would have been like, oh my God, I was a genius to have invested in Amazon. Because yes, you would be a multi whatever, right? Millionaire, billionaire. What beginners miss is that Amazon dropped something like, what was it, 80% 80, 90, whatever, it doesn't even matter. The point is it dropped way more than you think is even possible. So all beginning investors should mentally assume the following. You've done your research, you picked Amazon or today's version of Amazon. Let's call it whatever, but Banana Incorporated. And you're right because your research was right, but then you forget that you don't go in a straight line from whatever $5 a share to 2,000 a share. In between, you will have something like a potential 80% correction. So now if you're a beginner and you wake up tomorrow or a month from now and you see that Banana Incorporated, which you are so confident about, now dropped 80%, what are you going to do? And how are you going to feel?
You're ripe for panic, right? When you're in that situation, particularly if it's the first time you've seen that happen. You haven't got like the battle scars of experiencing it over 10, 20 years.
Right. And one of the things you're going to do is you're going to say, I was wrong. Right. And the way you're going to say that is actually maybe not to yourself but by pressing the sell button, which is the classic buy high, sell low trap. So maybe what we're trying to say, as per last episode, is do the mental work to prepare yourself for the quasi-inevitable correction, and then double check that you're not going to be selling out of panic, but rather understanding that this is just how things be. And really, at that point, the only, I think, serious decision would be, is this a good time to add more? In which case, I would then bring in my technical tool set and kind of wait and pick my moments to dollar cost average rather than just do it because I feel like I should have more shares now. But that's a side issue. It would be anything but selling if nothing has fundamentally broken.
And yeah, and certainly doing nothing just like that because the price moved up or down. To like go back to your plan. What was your thesis? Maybe if you use technical trading indicators, you go and review those. Maybe if you use fundamentals, you go back and reread like the last quarter results. Maybe stick the next quarter in your diary and put aside like 2 or 3 hours to review that quarter when it comes around. But just reacting because the price moved, that's almost always going to be a mistake.
Right. And actually, to bring it back to ASTS at the moment, it's a pre-revenue company, for one. So my whole investment thesis badge is not based on something like, discount cash flow models or multiples. It's primarily, almost entirely thesis based in terms of narrative. So I have that story completely locked down. If the price were to drop 50%, that is irrelevant from the thesis statement. It allows a better valuation and all of that. But why? It's almost inverse. Why would I sell at a better valuation if it had nothing to do with the story? So point being, people confuse price with value in company and so forth. So I would actually in some ways welcome a huge correction to ASTS because I could buy more shares before the actual thing starts playing out.
Right, exactly. Now, don't just take our word for this because you may have heard of Peter Lynch, like legendary investor. Now, he doesn't make live appearances often. You don't see him on interviews. He was a big guy. He ran something called the Magellan Fund, did like incredible market-beating returns for decades. But he retired from that in the 1990, I think, sometime around then. And he's kept a pretty low profile since then. But he just did an interview this month with an incredible podcast called The Compound and Friends. So we're going to drop a link to The Compound and Friends episode 211 in today's show notes. Don't take our word for it. Go listen to this interview and take Peter's word for it. And so, let's just pull a few lessons out of that Compound and Friends, because I think Peter Lynch's approach is really aligned to the way we think about stocks. And it's probably not coincidental because I've not read his classic book. Was it One Up on Wall Street? But certainly the lessons from that have infused me, because I've got them from other, I've probably read your own writings on that over the years when you used to write for the Motley Fool, right? I've soaked this stuff up, and it's certainly core to how we talk about being a long-term investor. Like Peter is so focused on know what you own. Like if you don't understand the companies you're invested in, you're much more likely to panic sell when the stock price goes down. He's a real advocate for researching.
Actually, Badge, can we unpack that a little bit?
Please.
It seems simple, know what you own, but I found that the way this happens for me is over stages. Like it's not like all of a sudden I go from not knowing a company to all of a sudden I know everything. It's more like once a company shows up on my radar, then I just systematically keep learning about it, and I keep, maybe if it's a product, I then eventually get the product, or I ask people about it. But it takes months. Often, like, it takes months. There are some exceptions where I myself was fanatical about the company. Actually, only two really come to mind, which would be Apple and Tesla, where I just, I knew those things because I was fascinated by the company, by the culture. And so I knew I had hundreds of hours or thousands of hours of, reading about it. But more usually it's like, okay, Lululemon. Okay. Do I want this? Do I not want this? Oh, I'll go into a store, right? But that takes time.
Yeah, you're right. And there's like an easy structure to build that knowledge over time, but it takes time, and it just takes, refreshing your due diligence. In today's episode, I'm going to show you how to look through a set of quarterly results. It's about doing that every couple of quarters, at least once a year, but ideally a bit more frequently, and just like build your knowledge of the thesis. Look at the competitive landscape. Go into the Lululemon store and look at what's on the shelves and look at how busy the store is. And then, check out like this summer's line of clothing, and does that fit your idea of what people are going to want to be wearing? It's that kind of stuff.
Right. I mean, it's not just that simple, but it is the most obvious and non-complicated place to start. If you then walk into the store and you don't like what Lululemon is selling, then why would you invest in it? I mean, really, like all of a sudden, then you're swimming, upstream, which is just not wise. Badge, could I talk about the second point on the docket here? Lynch says, avoid playing the market. Investing isn't a game. It's about buying good companies you understand. So that's a little bit of a segues with the first point. I would reword this differently, as you know. I would simply say, know the game that you're playing. And if you call yourself an investor, then do all this stuff about understanding the company and the fundamentals and knowing the product. If you're interested in something outside of investing, which I would call either swing trading or momentum trading, then you first have to say, this is what I'm doing. And then I would still go and understand the company, especially in the swing trade stuff, because that takes months sometimes to unfold, months or even a year or so. But I'm not so prohibitive about avoid playing the market. It's just a different thing.
Yeah. And actually, one other point, like later in the interview, that Peter brings up is, which I'm terrible at, I think you're potentially quite good at. He says, like, be open to investing in less glamorous companies. Like sometimes looking for companies that are improving from a like crappy to semi-crappy to better to terrific is like a good journey. And if you can catch them at the crappy stage, but you can see that trajectory, like I'm terrible at that. I'm always like poo-pooing. It's like some of your like, I call them like, like your bottom of the barrel ideas, but if they're on the right trajectory, then it can still be a legitimately incredible investment.
Right. Multiple ways. This is great news. Multiple ways to win in, let's call it, in broad strokes, in investing. One is to do what you do, primarily, which is in this, I'm going to simplify a little bit, but you're not trying to be smarter than the market in a sense. You're buying excellence. You're acknowledging that excellence tends to remain excellent. You watch the valuations so that they don't become too excessive, but you're betting with the market because that's just easier. You're swimming with the flow, right? I mean, it's just don't overcomplicate things, right? Excellent is excellent for a reason, and if you're patient enough, that will unfold to your benefit.
In the main, like I'll caveat and say there's exceptions, like Novo Nordisk, I'm adding to as recently as last week, and like it's in trouble as a company. They have to prove themselves. But yeah,
right. But in general, the flip side, right, and this is where I've turned much more toward, especially over the last 2-3 years as we began podcasting, because I became not enamored, but maybe convinced is also too strong, but certainly deeply curious about this idea that being a contrarian, if you're right, of course, pays way, way, way more than going with where the trade is crowded already. And the reason I began looking here is because, I was really scared at what was going on in the market, all these high valuations and, and then things were looking really bad. So I thought I got to get more, call it exposure to things that are being overlooked. And not everything that is overlooked is bad. It's kind of the sentiment thing. If things are out of favor, people make very poor assumptions about this out of favor stock simply because it's the momentum thing, right? It works both ways. So the trick, of course, is discerning between genuinely bad or value traps, bad for good reasons, versus it's just been overlooked, or people don't understand it, or there's a catalyst coming up, or all these other ways. And that to me is actually in a sense more fun because there's a lot more stuff to study and ask questions about and poke holes out, that kind of stuff.
there's an interesting, like in that interview, Lynch made like an interesting observation that I didn't agree with, but when I think about it more, actually it's quite astute. And it was that like this, we had this sort of meme stock phase with like stocks like GameStop, and it's happening right now with like Beyond Meat and like a bunch of other companies. And like his observation was this was reckless, but the meme stock trend encouraged a lot of younger people to open their first brokerage account. So, maybe those investors are now kind of graduating into being a couple of years in the market. They're starting to learn lessons. And then maybe that means they go on to eventually, running a mature portfolio and having some good discipline. Like if that's how you got started, like no shame in that, right? Getting started is the most important thing.
This will take us to a little bit of a tangent, but I think there's something to be said, because I saw your ex reply to someone. It was the Beyond Meat versus Open Door comparison.
Oh yeah.
Funny, because I joked that this is like 100% of my portfolio because at the moment I've made money in both of these. But here's the thing. I think you're right. The people investing in Beyond Meat at this moment are gamblers, or call it pure momentum. I did it out of pure momentum trading stuff, and I said to myself, I'm going to just be quicker than these other people to exit when it's time to exit, right? But I at no point was confused about what it is I'm doing. Sometimes it's fun to go into a casino, right, and put some chips down and spin the wheel, right? The young investors that we're talking about, that just opened up their Robinhood accounts and see this thing going up hundreds of percent, they're in bad shape because they will learn the exactly wrong lesson, right? They're going to think it's easy, or this is what stocks do. It's the whole GameStop phenomenon, right? What's interesting to me is that, as you pointed out, with Open Door, it is what I want to say is, it starts as a meme stock, But then you dig more and you see that there are actual fundamental real reasons to own this, but it's more of this gray area, and it's more complicated, especially for the average investor. So it's not like all the stuff is bad, but you really have to study and understand and put the time in. But a side point I think that I want to make, Badge, there's something happening right now in investing. I don't know how to phrase this exactly. It's something like the information that's available to everyone and how quickly it's available and how quickly people now act on it. It's like a paradigm has shifted. It's like we're in a different world than we were even, I don't know, 3 years ago, 2 years ago. And I think it's more like a neutral thing. It's not that it's bad or good. It's kind of technology in general. It's how you use it. So there will be some people that take all of this meme-ish stuff, and they take and then they pair it with time and time to investigate, and then they will figure out which things are actionable and which are not. I mean, saying the professionals will do this, and then they'll be able to potentially play both games and win. But for the beginners, I think they might confuse themselves, right? Or learn the wrong lessons, or just so it's like major warnings here and opportunities. But
Yeah, like, just being introspective and focusing on good quality decision making is always going to be like superior to looking at your results. Because what you're describing there is like the beginner poker player who goes into the casino, or maybe they sit down at roulette or blackjack, whatever it might be, and they're gambling, and they come away and they win the first time they play. Like beginners always win like their first session of poker, and they come away thinking, oh, actually, I'm a poker genius. I just discovered this. I should have started playing years ago. But that's just like, that's like probability messing with your head. Because in the long run, if you're an inferior player at the poker table, you're going to lose to the better players. It just takes time for like all the probabilities to like play out.
Isn't that a fascinating law of the investing jungle too? You're right, that poker player beginners always win, and the analog in investing is any beginner that starts options, they always do stupidly good with the first or two options they buy. The universe ensures that happens, and then they lose.
That was me. That was me, dude. Like one of the first options I bought was like a joke, just to like piss you off, because I think you were in Upstart for a long time when we both worked for Seven Investing. Then you sold Upstart. I'm like, I'm gonna get him here, and I bought some like out of the money Upstart calls, and they like at one point, like I bought $2,000 worth, like an entertainment stake. They were like 25, 30 grand at one point. I was like, what the hell? And I ended up selling at like 12 grand. So I still locked in like a nice profit. But yeah, and I'm like, oh, I'm obviously an options genius. And I've, lost like a ton of money on my other entertainment options since then.
Yeah, you're not an options genius yet. Wait till Monkey gets through schooling you. then you'll be a options genius. But yes, all right.
Right. Anyway, there's like a bunch of other stuff in this Lynch interview. So do go check it out and don't take our word for it. Like there is a way to navigate, like the mental mindset is the important thing here. Because if you get that in your head, I can't lose, at some point you will lose. Like just to reinforce something I said last week, because this is absolutely true. And if you don't believe me, we will live through this at some point. And then I'll reaffirm how I feel. Like I know sometime in the next, let's say 5 years, I don't know when, could be next week, could be 5 years time. I know I'm going to tune into my investment portfolio and I will start hitting like a protracted downturn in like the real amount of money that I have available to me. And it could get as ugly as like 50% drawdown, right? I could get wiped out over like a sustained period. It's not going to drop 50% overnight, but it's going to be like 5%. Then the next day, it's going to be like another 5%. And it might go up a bit, it'll go down a bit. We're going to have a chunk of time, which could last for years in itself. I'm not making any predictions. and I'm going to be sitting on big drawdowns. And so, like, you could say, okay, Luke, well, you're an idiot. Why would you do that? Why don't you just sell your stocks? But like, I don't know when that's going to happen. So the only way I know how to navigate this is to be like mostly long stocks, like mostly be an owner of companies, and then prepare myself mentally for when that downturn comes. I don't think I can time like the downturn and go to cash. I'm just making small nudges, and I accept that I will be sitting on massive drawdowns, feel like a schmuck, but I've seen it before, and I know I can just continue like working through that. And it might take a couple of years, but we'll come out the other side, and then we're in like another cycle, and we're going to finish that cycle, and I'll be worth like 2 or 3 times what I'm worth today. That's just the nature of the cycles. You just got to do the journey. You got to feel the pain and do it anyway.
Right. So see, this is where advanced level. There is advanced level stuff you can do with options to kind of help when the market turns, but that's another episode or another bunch of episodes. Fundamentally, another one of Lynch's points was do not get scared out of good investments. That kind of ties what we're talking about together. I pretty much guarantee you, that even during middle huge drawdowns, you will not see me selling EOS. You will not see me selling my ASTS. You will not see me selling iron unless there's something fundamental wrong with the company, right? So I'm only going to be thinking how to add here, not sell. Okay. But the other point, to reiterate something we've been saying for a long time, hopefully, well, our regular listeners are really hearing when we say this. Right now, we're getting a lot more Patreons. Our YouTube channel is growing. But I'm betting that I don't know. I'm not betting. I'm hoping that the majority of the people listening to this right now forget about the stock tickers themselves, forget about what's gone up or what's gone down, that our listeners are taking to heart the fact that this community together will help you sort of persevere through those inevitable downturns, because you won't feel so alone, and you will see us posting all our losses, and we will kind of work through our anxiety and panic and all of the bad stuff together, so that we're not just like bears of doom and gloom, right? Like, but we are truth tellers. And so that's what you've joined us for. I think that's the real thing that differentiates us from, say, a stock picking service.
I think so. Yeah, I think so. Like we're trying to give it to you straight. We've been on this journey, and like come on this journey with us, because we're all going to feel the pain together, and hopefully we're going to emerge unscathed the other side.
Yeah. And I think I said this last episode, the people I feel bad for legitimately are the ones that will inevitably cancel our subscription, when they experience those losses, because they won't either have heard this or they won't have taken it to heart that it's part of the journey, and they will make the wrong conclusion saying, oh, their stock picks were wrong. And that's the whole poker resulting fallacy. So, but then they'll resubscribe when the market's at next all-time highs 3 years later, 4 years later. Oh, anyway.
That's how the world works. And unfortunately, it's why most individual investors lose money in the stock market, for exactly that. Anyway, shall we move the docket forward, and shall we talk about like how to be an investor and how to review like company financials when you get a quarterly results?
Yes, because rumor has it Badger had some cash register dinging, chinging, ding, 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 ching, ching, ching.
Yes, cash registers were chinging for me last week because Intuitive Surgical dropped their latest quarterly results, Q3 results. And I thought, so we got really good feedback on episode 103 and 102, where you took us through, I think, some of the PayPal numbers with fiscal.ai. And then last week, I looked at Novo Nordisk. So I thought I'll come back again. We've just had a company report quarterly results. It's a company I'm pretty close to. It's like the second biggest company in my investment portfolio. And I thought I'd show you how I use these kind of tools to actually review a company. And I can do this in like an hour or two now. It might take you longer when you come to it for the first couple of quarters, but each time like you're learning more. I'm going to give you like a whirlwind tour through the most important aspects. All right, so we're going to start with fiscal.ai, and we're looking at Intuitive Surgical, like the main homepage. We saw this last week. And as usual, we've got like some nice headline numbers, market cap, PE ratios. And I'm going to say, like, this is a great home base to start your research. But what we're going to look at, because they just reported quarterly earnings, we're going to go and look at the actual quarterly earnings, which you can get if you go to Intuitive Surgical IR, Investor Relations, but you can get them in fiscal.ai too. And every quarter, typically you'll get a couple of things. You'll get a report, which is like the 10Q, and it's literally like a PDF document that you download and you read through. And then you get like, usually, not all the time, you get a bunch of slides that you can look at. And again, you can usually download that. It's like a PDF you can download. And if you hang around like an extra day or so, you get the earnings report, which I highly recommend you listen to with your ears, not read the transcript, because you get a lot of human nuance out of hearing like the founder, the CEO, like the leadership, the CFO talking about the company and fielding sometimes quite tough questions from analysts.
Badge, a side note there, so a quick side note. It's fascinating. There have been very, very good and serious investors who legitimately put a lot of stake in the literal tone, meaning it's kind of gets maybe not into woo-woo stuff, but certainly like, oh, they were downbeat, or oh my God, they couldn't be more excited. They were jumping out of their pants. That is, we can assure you, a legitimate data point.
Yeah.
It's not the only data point, but it's a legitimate data point.
Yeah. Like as poker players, right? You can hear something in the inflection and the confidence, and you can hear when they're winging it a little bit, because these are live. Like these calls are live, and they're there on the call with analysts, and we get to hear it all. So it's useful. Now I'm going to jump out of fiscal.ai just because I've taken the report, the slides, and the transcript, and I've just dropped them into PDFs, and I want to show you guys those. But before I do, I'm going to say this is my starting point, actually, and it's something I did a year ago. Like Intuitive Surgical is a company I know well, and so like you don't have to do this, but for companies I was doing it because we were scaling the YouTube channel. I built like a nice fancy deck where I explained the thesis and what I thought the competitive position was, and I pulled out some financials. Like you can find this on our YouTube or link to this video from like a year ago. But the reason I'm reflecting on it now is I had an investment thesis. So my investment thesis for Intuitive Surgical has pretty much always been pretty close to this, which is, if you're not on the YouTubes, like this is very visual, get on the YouTubes. But my key thesis is like they are a market leader with a massive competitive edge that I feel is almost insurmountable. They've got, I'm tongue-in-cheek calling it a robots and blades business model. It's the razor and blades business model. Like they make most of their money from the instruments, which they get used for a couple of procedures and they're thrown away. The actual robot, the hospitals buy or lease the robot, but most of the money they make is because they buy, these accessories that are consumables. The company is unlocking new opportunities with DaVinci 5. It's its latest version of the robot, essentially, launched a couple of years ago. They've got a rock solid balance sheet. And really interesting right now is they're collecting really interesting procedure data, which I likened in my thesis a year ago to Tesla driving miles. With DaVinci 5, which is 10,000 times the processing capacity of previous iterations. They're capturing video data. They're capturing like the surgeon's movements. And they've got all this data in a big repository. And now they can start to, a bit like FSD with Teslas, they can start to use that massive data from millions of procedures to start to do some quite interesting things. And we're now starting to see that. So let me take you into this quarter. So I've just downloaded from fiscal.ai the 10Q, which starts off with like a nice, actually pretty story that's come from the board that tells you what are the highlights of the latest quarter, what's their outlook, what's coming up. And I'll take you into a few bits of that. I've also downloaded the investor presentation, which is some nice, handy, easy to read slides. And I downloaded the transcript. So I've got one thing I want to point to in the transcript. So let me just take you on a quick tour of the highlights of the Q3. So I haven't highlighted all of these financial numbers, but if you read through them, essentially good growth ahead of what they expected. So they've grown both the number of robots they've deployed into hospitals, they've grown the number of procedures they've performed, they've grown revenues, really solid. I wanted to call out something that's a little bit unusual. They repurchased 4 million shares in stock. That's great. That's kind of directionally about 1.2% of the share capital. So that's like a real 1% increase in value in your pocket when the company does that, essentially. Now, if you read through the story, the company have placed 427 Da Vinci surgical systems in the most recent quarter, of which 240 were Da Vinci 5. So that's like more than half of the new systems are Da Vinci 5, compared to third quarter last year, or a year ago, where 110 out of 379 were Da Vinci 5s. Makes sense. It's a new system. It's scaling up. But this is helping me validate my thesis that Da Vinci 5 is rolling out, becoming a bigger part of the platform. And we can see it in the numbers. I've got some yellow flags in here as well, though. Like, it's not everything is always glowy. Share-based compensation of $206 million. So that's kind of high, but relative to revenue of $2.5 billion, it's reasonable. It's certainly not like an Axon. We talked about that in a recent episode where I think more than like a quarter of revenues were going to insiders. This is a much more sensible, like less than 10% of revenue. Still a big number, but it's not egregious. They've also, I was focusing on their fortress balance sheet. They did have $8.5 billion in cash. That's gone down, another yellow flag, gone down by over $1 billion because of they rebought common stock. That's like the buyback, plus capital expenditures. Like they're actually building more facilities and they're increasing their ability to manufacture instruments. So again, when you read into the story, it makes sense. They're not spending the money on stupid stuff. So that's probably enough for that. But if you were to go through this whole document, like you've got the financials, we talked about how to walk through the income statement in last week's episode. You can start to draw out some insights from this. Like here we are in the financials. Inventory is up $1.5 billion to nearly $8 billion. So there's a question for me to answer there. I haven't answered that yet. Why is inventory up? Could just be because the company's scaling. If you're scaling, you need more stuff because you've got more people buying your stuff. That would be a good reason for inventory to be scaling. A bad reason for inventory to be scaling would be like people are buying less of your stuff, so it's sitting on the shelves. So we can get a lot out of the numbers. But if that's like feels dense and not very pretty, then let's just flick to the investor presentation. Now, not every company makes one of these, but a lot of companies do. And it's a really pretty easy picture way of seeing what's happening in the company. And just like 2 slides I'll pick out of this because I think they tell the story really nicely. Here we are on slide 6, worldwide procedure growth up 17% for the whole year 2024 to the whole year 2023. So we're looking back a little bit and you can see general surgery is up significantly. That now makes up more than half of all the surgeries that are performed. So like growth of general surgery, this is intuitive coming out of its like little narrow space where it used to be just about like urology, prostatectomies and those kind of operations, and now going into like appendectomies and a whole bunch of other operations, general operations, which massively expands the TAM, like the ability for the company to do more procedures in more areas, which is going to increase growth. And then the other slide I want to look at, because it's my robots and blades business model, there's a stop here quickly. Look at that pretty thing. Da Vinci 5, like this.
Looks like Wally.
Yeah, does look like Wally. Yeah. It's a beautiful piece of equipment. But let's take a look at slide 21 in the deck, which is how the revenue breaks out. And revenue, we just saw up 17% year over year. 84% of revenue is now recurring revenue. So that's like, it's almost like a software company, not a hardware company, because it's making every year, it sells the robots, and that's like non-recurring revenue, but it also services the robots and it provides these instruments. And this is where, every year the hospitals own these robots. They're doing the procedures. They got to keep buying the instruments because otherwise they can't do procedures. And they're sitting on this like robot that's no use to them. That money's coming next year and the year after that and the year after that. So you can be really confident about the trajectory of the financials with a company that has high levels of recurring revenue. That's one of the main reasons I love Intuitive Surgical.
Badge, great job, first of all, in encouraging, walking us through the process and on making this your second largest position and on the results. Monkey, though, wants to screech and holler about something adjacent to this that is very timely. And I'll talk more about this next episode probably. But you know what I did? Okay, you know what I did? I'm like, damn, that badger is one smart badger. And then I employed a fallacy. I was like, I got to get me some of that Intuitive Surgical too. But damn it, it's already a $194 billion company. And the best that, I'm not going to match his whatever 10,000% gains or whatever obscene number you have. So I'm too late. So note that I'm aware that this is a fallacy, but I nonetheless did it. So I'm like, I got to outsmart him. How am I going to outsmart him? And so I had been doing research on another young up-and-coming health robotics company, but it was this. But I was in my research phase, right? I wasn't yet ready to pull any triggers. But the superior results kind of just got me more motivated to start really digging harder. And you know what I discovered? I discovered, in part, that the co-founder of Intuitive Surgical, whose good name is Mr. Frederick Moll, he basically invented this thing out of thin air. He wrote the business plan. He funded it. He did all the things. He is a American physician, so he's a doctor, BA from Berkeley, MD from just all the fancy degrees, really. I mean, he's just one smart fellow, obviously, right? He bought a massive amount of shares in a little up-and-coming health biotech called Procepts Biorobotics. And then, and so my thinking, really, not to overcomplicate this, is who knows more about this field than this guy? Probably few, very, very, very few people on the planet. And so I accelerated my research on the back of sort of, I call it reverse engineering. When somebody like Moll buys companies of my $2 billion robotics company, I'm like, I'm going to pay attention to this harder than any other data point out there. And so I ended up really loving what I discovered in my own research, and I bought a couple of shares for the King of the Jungle portfolio. Now, side note, our good man, Ben Galtiger on Patreon, he's, I believe, works in the healthcare field, and he did some on the ground. I think he said he talk to urologist friends of his, because PROCEPT Biorobotics is a prostate surgery company, right? So he talked to his physician friend, and I believe the intel came back that this physician friend was less than enthused, right? And I think Bengal said that this is anecdotal and so forth, but it's an interesting investing moment, because if you think about it, you get faced with this kind of mixed signals all the time, and sometimes investors overthink things and confuse themselves. I'm I don't think I'm guilty of this. When I see Intuitive Surgical becoming a company that's now worth $194 billion on the back of your research, and I saw how you participated and it basically made your career in some ways, right? And I see a person who knows this industry because he invented the damn thing, buying massive amounts of shares for higher than what they're selling for right now in the same sector. At that moment, technically, I'm like, how much more research do I need to do? Not much, right? At the very least, like, take a little nibble and then, follow up, and like, I don't need to be smarter than that. I will be, because I'm going to do the due diligence and all that, but that's enough. And I'm not going to get psyched out by one anecdotal physician's viewpoint, probably because when paradigms shift, people know what they know, and they're going to say, oh yeah, this newfangled thing, that's not going to work because my way is better, because that's what I do for a living. So, yeah, you will get cross currents, but I'm gonna outsmart you, and I'm gonna make all the bananas with my little Intuitive Surgical Junior. Just you wait and
Good
see.
luck. Good luck to you. I haven't looked at that one. I will take a look once you finish your DD if you're still happy with it.
Yeah, I'll do a Safari stock segment on it probably in the coming
Stuff.
month. But the trade was posted in our Dolphin Trading channel for all you Patrons. But that's all it was. It was like, here's a ticker I researched. Here's what I bought. Here's a couple things I like. The rest is on you.
Bengal Tiger, like that guy's got good taste. He was just a crowded house concert at the weekend, I think. So adding incredible value to our Patreon. So thanks so much for that, Bengal.
Yeah. Rawr.
Alrighty. So I did a whirlwind tour through quarterly results for Intuitive. And I did want to quickly, before we hand over to you to give us a tour of PayPal, I wanted to quickly headline an incredible guest that we're hoping to have on the podcast next week. I'm not joking. One of the world's highest volume robotic surgeons. He wrote the UK's NICE guidelines for robotic surgery. That's like the National Institute guidelines. And he's a world leader in training other consultants in how to master the Da Vinci surgical system. So this guy knows his onions when it comes to Intuitive Surgical. I know the company. He's hands-on and teaching other consultants how to use it. Like, we could not get a better, more expert guest to take you inside the operating theatre and really understand this technology from the practitioner's point of view. So interview episode coming up, hopefully in episode 105. If you're a fan of Intuitive Surgical, or if it's on your watch list, definitely must watch.
Excellent. I wonder if he has a view on my little new discovery. Can't wait for that conversation. Cool. Badge. I have a legit live investment question that I thought we could work out together on the show. So you're not prepared for this because I didn't give you any notes, but I have a decision I need to make before today's trading day, and I wanted to walk you through it and go back to my process. This revolves around PayPal. I think our listeners know that I added a couple of shares outright in King of the Jungle because I liked what I saw in my initial research. And then I did something a little foolhardy, which might be foolhardy. This is what I need to decide on. I bought PayPal calls dated for March 20th of 26. We'll return to that. for a second. That's my question is, I don't know whether I should keep them or sell them before the call, because I'm starting to have some doubts. We'll talk through that. But in order to deepen my research and understanding of PayPal even further, I used the fantastic reverse discount cash flow spreadsheet that you made. And a funny thing happened on the way to heaven. I think it's funny. I think I understand. But when I put in, and by the way, it's very simple. Badger made it incredibly foolproof, where you could just follow his steps, and it's great. Because PayPal is a mature company that produces cash flow, it's ripe for exactly this tool. I don't usually need to, at least the way my portfolio is constructed, I don't usually need to use it, but for PayPal, I do. And when I put in the numbers for PayPal's cash flow relative to its market cap, it broke the spreadsheet, because the column that calculates it basically said free cash flow too high. Like, this can't be true. Like, this can't be true. And lo and behold, it is true. Management is in fact predicting $6.5 billion of free cash flow for 25. And when I put in the rest of the numbers, when that box showed up, I believe that error comes because then that tells us that the implied value is that for those numbers to make sense, PayPal would actually have to stop growing and start declining. So we get an error. That's my interpretation. So in order for me to prove that that was true, I increased the discount rate up to from 10%, which I think it's actually quite aggressive for PayPal. I think PayPal you could argue for something closer to 9%, but I increased it from 10% to 11%. Again, side note, the higher that rate is, the riskier the company, the heavier, the more like you have to basically justify a greater return because the risk is higher, right? So when that number goes up, the risk gets higher. So anyway, I had to move the PayPal discount rate to 11%. And then when I did that, finally we got an assumed growth rate of, I believe it was something like 1%. So basically, in order to even get today's valuation to make sense, I had to over exaggerate the risk, I think, that we see at PayPal. So I did that. That's a side note. And that confirmed that PayPal is either absolutely bottom fairly valued, and the only way it doesn't make sense is if it actually starts declining, its revenues start declining, which of course could happen. Here's my question to you. As I started getting excited about PayPal, I ended up buying a call for March 20th, 26, that will profit the way options do if the stock price goes up basically between now and March. But the more I was thinking about and researching PayPal badge, one other thing. The reason I picked March was because I was getting 2 earnings calls in there before expiration. I'm going to get the one tomorrow, meaning tomorrow as of the recording date. You listen to this in the future will already know how PayPal did, but me right now, we don't know how PayPal did. But anyway, I get that earnings call, and then I get another one 3 months later. And initially, my thesis was I already can sniff the turnaround happen. The last earnings call, you could see the numbers are now trending in the right direction, but the market reaction was actually muted. And my tingly sense says, no, this is going to be the earnings call where we're really going to start to get traction in the market. Maybe if not overnight, in the coming weeks, we'll start reevaluating it. And if not this one, then the March one. But the more I studied this badge, the more I think sometimes things take longer like the re-rate, the fundamentals might be sound, but it's still going to take longer for the market to properly recalibrate, especially a company that's around 60, whatever, 5 billion, 67 billion market cap. So I'm sitting here looking at my King of the Jungle portfolio badge, and I have 3 options right now open. 2 of them I'm confident in, but the PayPal one uh, right now is worth $239. I bought it for $340, so I'm down $100. That's a loss of 29% on this trade. And if I based it on that, it'd be anchoring. It'd be like, well, I paid more, I paid more, so I don't want to sell it. But I'm better than that. So I'm debating selling this before earnings call, pocketing the bananas, and if PayPal actually does, deliver superior results, like I think is possible, then, well, I'll have cost myself hundreds of dollars of profit because, if the stock jumps up 5-10%, the options would have made it even more. So that's one thing. I'm like, damn, it might cost myself a lot of money. But then if it doesn't do well, right, I could, of course, rebuy the options for a later date cheaper. And I'm legitimately not sure what to do with this. And I'm curious given what I just told you, and since you're kind of the fintech resin expert, you have PayPal's competitor in your portfolio in the Adyen, and you study this stuff, and I think you have a better natural sense for what PayPal might say, and or how the market might react. I'm curious whether you would advise Monkey to just sit on his hands, and I made my decision. I get 2 earnings call shots, or maybe I was too aggressive in my timeline and it's a little too short dated to profit.
I know nothing about PayPal, but maybe the question is, I can help you try and answer for yourself is, like, what's going to happen in the world between now and March? Maybe, like, who knows? Things might stay the same. And then, I know you have to work out what that means for PayPal.
I do have a strong thesis I haven't gotten into yet because, I haven't done a deep dive with you. I do have a strong thesis that says PayPal is turning around. There's things I'm going to point to, but that's, I think, adjacent to, is that going to be quick enough, so to speak? Will that happen quick enough to proliferate through, call it the fintech ecosystem? That's the thing I can't quite answer. And that's the bitch, pardon my language, of having a shorter-ish call option for March, because I could be right, but it's going to take them, say, till June rather than March to really.
Yeah. And that is that's the downside of using options as opposed to just buying the stock. Like, if we reflect on, you sort of, you dry your tears when you remember that you bought Rocket Lab calls, you didn't buy Rocket Lab stock, then the calls expired worthless, or, it didn't play out because there was like an end, like a time date on that, and they expired, or you had to tell them. But if you'd own the stock, you just own it in perpetuity, come hell or high water. And in this case, it was like high water. So if your long-term thesis around PayPal is positive, you might as well buy the stock. Obviously, you get a discount when you buy it true options, or at least you get more leverage over your capital, that you can control more stock with less dollars if you do it with options than if you just go buy the stock. So I can't tell you. I've got no idea. Like, I'm a bear on PayPal, but only because I personally don't like the platform. I don't like the business model. I think companies like Wise, to the extent that they overlap, they don't really overlap at all. I think something like Wise is a better proposition for users. But PayPal have a huge volume, and so there's a bunch of people using it, irrespective of all the anti-competitive nature of the FX that it operates. That's why I don't like it. But I don't know your thesis. It doesn't talk to your thesis. But what's going to happen between now and March? You're going to get 2 earnings calls. Maybe the world is going to stay the same. Maybe we will tip into recession. Like, I hate to use that word again, but like it's possible. And like I've certainly got it front of mind with when I'm adding money to companies right now. And like Intuitive Surgical is in my mind recession proof because most individuals will spend on surgery through their insurer, and you're probably going to continue to have insurance in the US, whether irrespective of your wealth level. Like if you in real terms, you have less expendable income, most people are probably going to still keep their insurance. It's not like a PayPal. Like, I guess the money is made from commerce and like helping transactions happen. And I would guess, again, I don't know the company at all, that the large majority of their money is probably from consumer discretionary. Because if you're going to go and buy like your baked beans and your nappies and like your household detergent and the stuff that you're going to buy, no matter what the economy is doing, probably not using PayPal for that transaction. You're probably going into like your Costco and you're using your credit card, but you might use PayPal. Tell me if I'm going totally off base. You might be more likely to use PayPal for like, some kind of fun purchase at something on, some e-commerce site or experience or something else. They're the kind of things you might cut back on if money gets tight.
I think, this requires a whole deep dive on PayPal stuff I'm pretty sure you don't know about yet. So I think for sure, my bullish thesis is way, way more bullish than what you're talking about now. I think they're totally rebranding themselves in ways that most people don't know about. But that's not really, for my question, let's just assume, and I know it's hard to play these abstract assumption games. Let's assume that my bullish thesis is more correct than not. I'm still left with the same question, which is I think if I talk it through, the reason I think I might have made a mistake is because I bought the option that I thought was long dated enough in March, but I'm starting to sense that that's still too short term. That's only 5 months. And that at minimum, I'm going to need 3 earnings calls to really either be right, proven right, or watch it basically flow through the system, which would mean the more appropriate one would be for June if I still wanted to take a pretty, aggressive bet.
Is that what, again, like you're sort of throwing a question at me. I can't really answer because I don't know what's in your head. But I would just challenge that. Like if March isn't long enough, why is June long enough? Like that's only another 3 months. Why not buy a 2027 option?
Right. Well, in my urban portfolio, my real world portfolio, not real world, my personal non-King of the Jungle portfolio, I have 27 calls. But in the King of the Jungle here, the 27 calls are way more expensive and I don't have the bananas to fund it. So it's a bit of a, for all our listeners, this is a bit, I'm skating on the thin edge where I could be completely wrong. And exactly, March isn't long enough, but the longer I go, the more it costs. And so that's the safer thing. And Wayne, I'm legitimate. Oh man. Of course, the moment I sell it, they're gonna knock it out of the park, and the stock's gonna jump 20%. But that's greed talking too, right? That's kind of like Momo mentality. And so I do, by the way, have shares too in the King of the Jungle. So I'm playing this both ways. Yeah, I'm really not sure whether before today's day I'm going to keep this call or not. I guess our patrons will find out in the trading channel to see what I've done. I think the safe way would be to sell them and be happy if they go up because I still have a couple shares. If not, be happy because I'll get the June options even cheaper. That's probably the mental model to go in and not get sidetracked by, trying to get to 1,000% gains for the year with 4 days left in our portfolio.
Are you actually close to we'd have literally 3 days left until the end of year 2 of King of the Jungle. are you within striking zone of 1,000% return over that year?
Wow. I think so. This actually didn't go in my calculations. I did not, obviously I did not predict that kind of outcome, or when I bought the PayPal calls. But if PayPal says what I think they might say, that could put me over the 1,000% gain with the call because of the massive leverage. I'd make hundreds of dollars on this prop possibly. So that is the greed. That's just fun and
do
games.
It. Like, we've got a bottle of rum bet on this, and I think the way the bet should work is, I bet a bottle of rum that you would make more than 500% gain in the year. If you make 1,000% gain, I get 2 bottles of rum for it.
Oh no! Come on, I'm gonna go bankrupt just paying you. Hey, investor who made 1,000% in a year still ended up broke due to his rum debts. Oh man. Anyway, it's I don't know. Hopefully for our listeners, it was interesting for me to articulate this tension between greed and thinking sensibly about greed versus timing things and using leverage, and how that conflates with thesis statement and due diligence and all that. So yeah, hopefully it was interesting to
you got to explain your thesis at some point. So yeah, do that on the podcast in a future episode, like why it is you believe this is a market beating investment.
Yeah, absolutely. And I'll have so much more relevant data starting tomorrow morning when they report pre-market. So
shall we bring today's episode home with a devastating estate tax that could wipe out 40% of your entire investment portfolio?
Do you want to do that, or do you want to save that for
I want to
next
do it
time?
Because it's top of mind for me right now. And I would feel bad if one of our Patreons died before next week and they were subject to this.
Hey, John, don't get eaten by any pythons or anacondas that are lurking in the jungle, please. But if you do, that has some really bad news for you.
Now,
other than that you're dead.
I'm being a bit alarmist, but this is very real. And I and my buddy Albert and a couple of my friends who study this stuff and know investing had no freaking idea about it. I was going to get potentially caught with my pants down. And credit to the Dividend Talk community, because our friends Edgy and Derek, amazing dividend growth investing podcast, and they got a really good community, and I'm in that community, and I lurk a lot, I read a lot, I rarely post. But this came up on their podcast 2 weeks ago, and I think it's really important, so I want to share it here, because I'm sure this impacts at least one of our listeners out of our thousands of subscribers. Right. If I had no idea about this, if you guys, you Americans, holy F, right? How did you sneak this in for the way you tax? Because it's completely.
Wait. So I'm the one that should be scared, or you?
You're good. You guys are screwing us. You guys are screwing.
Good. Oh, good. Okay.
Yeah, good. This is so counterintuitive, right? I thought I was deluded into thinking, oh, I'm good. I've got a will. I remade my wills recently, and I got to pay, UK inheritance tax, and I'll make some provisions and structure around that, and I'm all set up. I have now learned about this US estate tax. So, if you are a non-American investor in many, many countries of the world, if you own US assets, which includes any US incorporated companies. So, like Teslas and Alphabets and Metas, like most American companies are incorporated in America. There's a few exceptions. When you die, your broker will freeze your assets, and they will require your estate to complete a fairly painful process involving submitting a 706-NA form, the IRS. And I'm not joking, your estate will have to pay 40% of all of your US assets to the IRS before your broker will release your funds to your estate so that your executors can deal with it. And if you're an American, like this tax applies to you as an American, but you have something like a $13 million exemption, estate tax, like buffer. So the first $13 million that you leave to your inheritors is tax-free. If you are a non-American leaving American assets, so like your Google stock, if you're leaving those to another non-American, like your wife, who is not an American, 40% tax on all your American stocks above $60,000.
So the difference is Americans get 13 million exemption, and you poor Brits and other foreigners get 60,000, which is relatively nothing. Like, right, 13, right. So, that's not good.
It's not quite right, because there are certain treaty companies. But if you're like in Spain, Ireland, Hong Kong, Singapore, Dubai, Portugal, that's it. That is the deal. Everything above $60,000 is taxed at 40%. And you can't get out of this, right? There are ways to structure, which I'm going to tell you about now. So if you're suddenly sitting forward going, what, like Google US estate tax, this is absolutely legitimate. I've been down the rabbit hole with this in the last few days. Now, if you are a UK citizen or Germany or France, there's a number of other countries, then there is a tax treaty between your country, between say the UK and the US. And as of the 1st of January, that means as a UK citizen, instead of being 13 million, my limit will be $7 million. So you might go, okay, like boo-hoo, right? But if you've invested for a long time, you might be sleeping on, by the time you get to your 60s or 70s, you might be sleeping on a portfolio that's worth more than $7 million. In fact, not even a portfolio, your net worth, if your net worth is worth more than $7 million, which is about £5.5 million today, then this tax kicks in and you would potentially liable for 40% of all of your US investments as a proportion of the $7 million. So
if I could summarize right now, Badge, bad news. One, you're dead. That's the first thing, right? And two, because you just got yourself eaten by some poisonous snake, your estate, the people who handle your business, unless you're part of a couple of these exempt treaty zones, you're going to lose approximately 40% in all of the U.S. incorporated companies. Is that correct for now? That's the summary for now. So is there any good news in any of this?
Now that you are aware of this, go and look into it. If you're in like a country like the UK, okay, sure, $7 million is a big number. Like not many people have that kind of wealth, but maybe plan ahead. And if it makes sense, like I am not a lawyer, I am not a tax advisory, I'm just telling you about this thing. Now go and do your own research. There are ways to mitigate this. And if you're in Ireland, like this is particularly important because you only get that $60,000 limit, not the $7 million limit. There's two ways to legally avoid this tax. One is, instead of owning individual stocks like Google and Meta and you buy a non-US domiciled ETF that tracks the US stock market. So you would buy, for example, we talk about VOO, VOO, it's like the S&P. So VOO itself is a US incorporated ETF. So you can't buy that one, but there are Irish and other markets have their own version of VOO, which track the S&P, and they're incorporated in the local country. So those would be outside the scope of this. So, but that's kind of boring, right? You don't want to own ETFs. You want to own individual companies. And that's like, this is like my mission is to beat the market, pick stocks. And so that's no good to me buying an ETF, but that would be good for the majority of people who aren't like dyed in the wool stock pickers. If you must own US assets. And if your intention is to leave like the majority of your estate to your spouse, then you can have it's recommended you create a US will, so a second will for the US, which have to meet certain criteria. Like you'll have to employ like a lawyer or an estate person to help you set this up. And your US will create a qualified domestic trust, QDOT. And that would allow your estate, at least your spouse, to defer the taxes, but the taxes are still due. So it just means push.
All right, Badge. Sorry. I mean, this tax talk is making my eyes roll in the back of my head. I'm sure half of our listeners already also might have died, but this is important. No, sorry, not died, because that would trigger all this. So they fell asleep or they fell off their chair. Let's get to the real most important point here. Let's get to the, as they say, the monkey business. All the bananas that you're going to leave your humble co-host after you kick the bucket, falling off some cliff, skiing, or jumping off wherever you're going to be jumping off a motorcycle. What do I got to do? What do I got to do to secure all the future bananas?
You're a US citizen. I could leave stuff to you, no problem. I just can't leave it. Yeah.
Oh, you can.
Leave it to you. I can't leave it.
You know, it's not like I'll reinvest it all in in Beyond Meat. I wouldn't do that. Would I disrespect your legacy in that way? No, I would put it all into Greg's sausages.
Yeah. Well, like, I am laughing because it's like the things like Greg's sausages in my portfolio are sort of the only positions that are immune from this. Almost everything else is US incorporated. But you're right, let's bring it home because most people this won't affect. But this is real. If you're not a US citizen and you own US stocks, you are exposed to this tax. If you're not in a treaty country, you're almost certainly exposed to this tax today, as opposed to in the far future. You should get legal advice on this if you think this impacts you. And the key thing is the place of incorporation of the companies you own. So it's quite interesting because I looked down my whole portfolio and did a quick bit of Google to see kind of where they're incorporated. So like some were a little bit surprising. Nubank is like South American, that incorporated in the Cayman Islands. So that's good. And I expected that. But Mercado Libre is also like south of the border, but they're incorporated in Delaware. So that's bad. That falls into the scope of this. IREN, one of your favorites, well, that's an Australian company. Great. Even though it's listed on like the NASDAQ, it's incorporated in Australia. So that's kind of okay.
Actually, they're moving to the US, but
Wise, right? They're a British company that are about to like re-headquarter and relist in the US. That's going to be bad for this because it will fall in scope. Shopify, company I used to own, Canadian, like immune. So that's the kind of analysis you need to do in your portfolio to figure out the extent to which you might breach this. Can I just give like one more minute to this topic? Because in the dividend talk community, they were debating like things that you could do. And it's almost like, half jokingly, I just want to kind of address these head on, right? You might think, oh, I'm just going to leave everything to my spouse. It's tax free. We've now established that's not the case. You can't expect your spouse to go into your brokerage and just quickly, they've heard you're dead. And the first thing they're going to do is go online and find your 2FA codes and log in and sell all your US stocks. Even if they were able to do, overcome their misery or celebrating, God knows, and successfully do that, that don't count. The IRS will look through that transaction and it will just make things worse and more complicated for the people who inherit from you. So if it impacts you, do it properly, get proper estate planning advice, and then don't get caught out as I may have done if I hadn't have caught that 2 weeks ago.
Just make sure Monkey gets his bananas when you kick the bucket. That's the TLDR. Okay. You sign the things. Okay. Badge, thank you for bringing that to our attention. Yeah. So Patreons, taking taking cue from the good folks over at the Dividend Growth podcast community, we mentioned that they have a cool thing where they solicit ideas from their listeners and they create their own community-based portfolio. And we think it's time to do a similar thing over at Wall Street Wildlife. So we will write a post, a longer, more in-depth post on the Patreon site at wallstreetwildlife.com. But the general idea is we want to hear your stock picks and your ideas. We'll give you a place to submit them, to make a case, and then we'll have a vote. And then each month, the winner will go into an actual portfolio, which will then compete against Badger and Monkey's portfolios. And then we'll have prizes and all kinds of delicious banana golden fruit as prizes, or maybe Badger will throw you some acorns. And I think it'll be a good way to help process all of the good research that you guys are doing, put it all in one place, and have some fun with it. So stay tuned, heads up on the Patreons. Badge, you want to add something to that?
If any community like this can deliver 1,000% return and beat Monkey, like, wow, that would be incredible. So really looking forward to seeing what our Wall Street Wildlife community come up with between them. And I think we'll aim to launch it like soon. So we'll get the details out in the next week or so, because we want it to go in sync with our King of the Jungle, because we review like every 1st of November is like the cutoff. And then, let's see how our community do. Like, what's that thing they say, not the wisdom of the crowd, but, when you're like counting jelly beans in a jar, it's like,
that's a real thing. That's a legitimately real thing, that the crowd will tell you better than the experts, because it's some probability networking flywheel effect thing happening. But yeah, that's exactly what we want to get started. So year 3 of the King of the Jungle Challenge will not be simply Badger versus Monkey. It'll now be Badger versus Monkey versus the jungle critters themselves. And we look forward to getting this started. So again, more info, we'll type this all up on the Patrons. If you're not part of the Patreon crew yet and you're hearing us on the YouTubes for the first time, please go check us out at wallstreetwildlife.com, where all of this will be in clear evidence.
All right. Back end of another long episode. Anything else you want to touch on before we wrap up for this week?
Nope, that's plenty.
Did you check out Tron mode in your Tesla? You didn't, shaking your head.
I did not yet see that. Let me write that down right now. I have PayPal March 20th calls to worry about. Badge, I got 1,000% to accomplish. I don't. Tron Ares mode. Okay, I will look into this afternoon.
And I haven't seen one battle after another yet either. So there you go.
Oh, so okay, so we're both flopping at each other, right? Okay, shame on you. Go.
If you enjoyed what we did with fiscal.ai, go check it out. If you go to fiscal.ai/wildlife, you'll get a handsome discount. It is a fantastic investing tool. Are you ready to become a beast of an investor?
Hell yeah, we're ready.
Your journey started there.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.